Good evening, students. Welcome to the session. I hope you have revised and studied for this class as well from your module. Have you? Yes. Good evening, Vanshika. Yes, students, have you studied? Let me just, till that time you answer, let me just give a quick recap of what we have done so far. So, we had started with the basic concepts, and in the basic concepts we started with like how does the authority to charge income tax comes from the constitution article 265. Then there is entry 82 in the list 1, and then we spoke about like what is the difference between direct and indirect taxes. So we did all of that, right? Like the basic kind of discussion that we did, and then we went ahead and started talking about that the charging section, which is section 4 of the Income Tax Act, which says that total income of a person of a previous year shall be charged or assessed to tax at the rates in the next assessment year. And we saw that what is the meaning of total income? It is as per 245, which is the total amount of income specified in section 5 and computed as per the provisions of the act, right? And the total amount of income which is there in section 5 is basically defining the scope of total income, right? So scope of total income for ROR, RNOR and NR likewise, right? And then we started speaking about the basically section 4. In that again we went ahead and saw like what are the rates of tax, and rates of tax are given either under the Finance Act or under the Income Tax Act. So the special rates are given under the Income Tax Act, and the basically general rates are coming to the Finance Act, and that's what we are going to discuss more today. And then we spoke about basically the person definition, which includes a company. We spoke about different types of company. So for determining the rate of tax, you need to know whether a company is a domestic company or a foreign company. Domestic company is one which is the Indian company, or the company which has made the prescribed arrangements for the declaration and payment of the dividend, right? So that is what basically are the two types of company. Is the audio clear? Because students are complaining regarding the same. Hello. Yes, is it clear? Yes, students. Okay. Yes, clear. So we were talking about the different kinds of company. So basically the company we said is that domestic and the foreign. So the tax, for determining the tax rate, you need to know whether it's a domestic or a foreign company. As I said, domestic is one which is Indian company, or the company which has made the arrangements for the declaration of dividend. We saw what are the arrangements for declaration of dividend is that you have made the payments here, you are maintaining the shareholder register, you are doing the AGM here. So basically all of that kind of gives an indication that here there is the declaration of dividend or the arrangements have been made for same. Then to determine whether a company is a resident company or not, you need to see whether it's an Indian company, and then the place of effective management of the foreign company is in India. So that is particularly for determining the residency of company. And then there are certain provisions which are applicable to widely held only to the closely held company. So the definition of widely held company is given. Widely held company is the either government or RBI owned company, it's a Nidhi company, or it is basically the listed company or a subsidiary of a listed company. Other than that, a private company or unlisted company will be a closely held company, right? So, yes, good evening, Shankara. Good evening, Viraj. Yes, good evening, Mansha, Prerna. Yeah. Good evening, Chitala. Mohammed, good evening. Yes. So, basically, audio is again not clear. Can please anybody confirm to me whether it's clear or not? Because some students are writing it is clear. Is there some problem in my audio? Yes. Okay. Okay, so people are writing clear, so maybe there's some connectivity issue at your end. Okay, so now moving towards now the tax rate. Okay, Because what we have done is scope of total income. We have spoken about the total income definition, the income definition. We also spoke about the capital versus revenue receipt, right? That there is a distinction between the capital versus revenue receipt. And for that, we discussed the case law of Saurashtra Cement as well as we discussed the case law of Honda TL, right? Wherein we saw how you have to determine whether a receipt is a capital receipt or not, because a capital receipt is generally not taxable unless specifically provided for that. Otherwise, the revenue receipts are always taxable, right? So we saw that if the receipt is in the course of compensating for the sterilization of profit-making apparatus, right? Sterilization of profit-making apparatus, which is not in the ordinary course of business, like the liquidating damages that we were talking about, and therefore that receipt would constitute as the capital receipt, right? Is it clear till now? Yes or no? Sorry. Yes, clear till now? So you have revised up till now, right? Now we move on towards the second part, which is the tax rate. What we were discussing about in the last class was only the total income that we spoke about. Now again, as I said, the total income into the tax rate will give you the income tax liability, which is going to be charged. And that's what your charging section also says, right? So now, as I told you in the last class, there could be the general rates of tax and there could be the special rates of tax. The Income Tax Act gives certain rates of tax. For example, for 111A for the short-term capital gains, 112A for the long-term capital gains, right? So all of that is basically in relation to the special rates of tax. We also have the general rates of tax. Yes, because diversion of income by overriding title and application of income. Yes, that's what we are going to deal with now in some time, and maybe you can post your query so that I can clear that query at that point of time. Okay. So coming to the rates of tax, which are first given in the Finance Act, and then special rate of tax we would be dealing with as and when we would be dealing with a particular set of income. Like for example, when we would go to the capital gain class, I will be talking about the 112, 112A, 111A, and there are different set of special rates for different category of capital gain. So that we would reserve it for specific chapters that we would be doing it, because it would be more connecting. Because right now, if I even give you the list of special rates, you would not be able to connect it. So we would discuss about these special rates of tax as and when we would be discussing about that particular income. Clear? Now we would be going into the Finance Act, which is the general tax rate that we are going to talk about. Okay. So now we are going to the tax rate each assessee wise or each person wise. Because if you know that the tax rates which are there are different for each category of person. So we cannot have like one tax rate. So we have different tax rate for different category of person. Now, if you remember in the last class, I was telling you about the Finance Act. I was telling you about the Finance Act. In the Finance Act, if you look at it, there is part 1, there is part 2 and part 3. What was part 1? The part 1 to the Finance Act gives the tax rates which are applicable for the current assessment year. Part 2 talks about the TDS for the current previous year, not the current assessment year. Current assessment year means the last previous year, right? Part 3 again gives the tax rate for the advance tax for the current assessment, current previous year. And part 3 will become again the part 1 in the next Finance Act. Right, so that we have already spoken about. Now coming to the tax rates, that we are now going to move. First, it is for the individual. Now for the individual, till the last previous year, the Finance Act was the default tax rate. The tax rates which were coming through the Finance Act were the default tax rates basically. So whatever you would have studied till now in your IPCC, you would have studied 2 lakh 50 and then 5 lakh, 10 lakh. That is the tax rate which is going slab wise. Isn't it? So basically that was the default tax rate that was applicable in the Finance Act which was given. But now onwards, there is a special provision which was optional until last year, but which has now been made as the default provision. So earlier, section 115 BAC. Start saying with me the section numbers as well. But that means you will remember the section numbers. Okay. So section 115 BAC was the optional provision until the last year. And the individuals, if they wanted to opt in, for that provision, they had to exercise that choice. So 115 BAC was the concessional tax rate provision. And the general tax rates were coming through the Finance Act. And if any individual wanted to opt in for 115 BAC concessional rates, they had to make that choice while filing their return of income. In the return of income, you would have done in your articleship, you tick for 115 BAC. So these returns which you would have filed in July, in these returns, you would have ticked if the client wanted to go for 115 BAC. So then you would ask, ma'am, why did we tick in the return if this was the optional, if this was the default regime? You are saying for this year, 115 BAC is the default regime. So then why did we tick in the return of income? Because return of income was for the last previous year. So your income of the previous year is assessed to tax in the assessment year. So you are getting assessed for your tax in this assessment year for the income that you have earned in the previous year. So in the last previous year, as I told you, even though the Finance Act now 2023 is what we are looking at, but for the last previous year, Finance Act 2022 was applicable. Right? Finance Act 2022 was applicable. And in that, 115 BAC till 2023 was the optional scheme. So if you wanted to go into that scheme, you had to exercise that option by ticking the box in the return of income. And those who had the business or profession had to file a separate form for that. Which means that they are exercising the option of 115 BAC. Are we clear? But this year onwards, the Finance Act tax rates have in fact become the optional tax rates. So this year onwards, your Finance Act tax rates have become optional. Now, if you want to go for the Finance Act tax rate, you have to exercise that option. So now individuals, HUFs, AOPs, BOIs, and artificial juridical person will have the tax rates default applicable to them as provided under 115 BAC, which is the concessional tax rate. So by default, if you do not exercise option, 115 BAC will be applicable to you. However, you can shift out of the default tax regime. You can opt out. What I was saying, the first term that I was talking about is that we had to opt it in. You have to opt it for the 115 BAC until last year. Now you have to opt out for 115 BAC in this year. Till last year, you have to opt in for 115 BAC, but this year onwards, you have to opt out of 115 BAC and shift to the regular provisions of the Finance Act, the tax rates prescribed under the Finance Act. Are we getting this point? Yes? Yes, good evening, Jyoti. So, Viraj, there would be many changes which are there, which are made applicable to the Finance Act 2023, which are only applicable for May 24. So, as and when we would progress towards the chapters, you would see the changes which have happened. Okay. So, 115 BAC is going to be the default regime from now onwards. Now, what are 115 BAC, or what is exactly the 115 BAC scheme? Let's try and understand. So basically, for the individual, you have general rates provided under Finance Act 2023, and you have concessional rate concessional rates under section 115 BAC. But this is going to be the default. This is going to be the default scheme. So I'm writing here not on the individual, but you can write it over here, HUF, AOP, BOI. Individual, HUF, AOP, BOI, or artificial juridical person. Right? Now they have to pay the tax in respect of their total income at the concessional rates. Now this is a special provision. 115 BAC is a special provision which is applicable, right? Now, if you were going for the general rates for an individual, like we were going for the general rates of tax for the individual. Now, at that point of time, when there is capital gain under 112, 112A, 111A, so then do you apply the general rates of tax or the special rates of tax? You apply the special rate of tax for the special income. For the income for which the specified rate is there under Income Tax Act, that particular rate will be applicable, and for the balance total income, the general rates will be applicable. Similarly, under 115 BAC as well. Now, 115 BAC is a special provision which is applicable. But despite that, 115 BAC overrides the other sections. It says, notwithstanding anything contained in this act. Now, what do we understand by notwithstanding anything contained in this act? Notwithstanding anything contained in this act is a non-obstant provision. Is a non-obstant provision, which means it overrides the other provisions of the act. Whenever the term used is notwithstanding anything contained in this act, it means it overrides all the other provision, and this provision will prevail over any other provision. That is called as non-obstant clause. Okay. Now, this particular 115 BAC is a non-obstant clause, is a non-obstant provision. Now, this will override all the other provisions of the Act, because if you look at Section 4, what does it say? Total income. Total income means the amount of income computed as per the provisions of the Act. Now, you will compute the income as per the provisions of the Act. Let's say, for example, I'm computing salary income. So I will allow standard deduction, house rent allowance. I will allow leave travel allowance. Similarly, I am computing PGBP. So I will allow the additional depreciation, scientific research expenses, investment allowances, all of that. Right? So that is as per the provisions of the Act only. But 115 BAC says, wait. cannot allow that. I'm already giving you the concessional rates of tax. After gaining the concessional rate of tax, you also want the allowances, exemptions, deductions. No, I cannot do that. So that is why it is saying I will override all the provisions of the Act. So it says notwithstanding anything contained in this Act. Meaning this provision, whatever I will prescribe over here, will prevail over any other provision in the Act. So the normal provisions will not prevail over here unless which are specifically given over here. But what it says, but subject to the provisions of this chapter. But subject to the provisions of this chapter, notwithstanding anything contained in the Act, meaning this provision 115 BAC will prevail, but subject to the provisions of this chapter, meaning that this chapter, what sections it contains. So I told you the Income Tax Act is divided into several chapters. So we talked about that, right, last time, that there are several chapters in the Income Tax Act. Now, this chapter, which is there, which is talking about the special rates of tax, which is talking about the special rate of tax, chapter 12. So whatever the tax rates which are given in chapter 12 will prevail. So if long-term capital gain is going to be taxed at 20% or 10% under 112, 112A, that will continue to be taxed at that rate. Because 115 BAC says, notwithstanding anything contained in this Act, but subject to the provisions of this chapter, meaning the tax rates which are given in this chapter will continue to hold good. I will not override this chapter. I'm overriding entire Act, but I will not override this chapter, which is chapter 12, which contains these or which consists of the special rates of tax. So meaning if there is long-term capital gain, short-term capital gain, or any other income which is taxable at the special rate, that particular rate will be applicable. So I will divide it again here into two parts. For the third part, I will write it over here, the income taxable at special rates on those specified rate under the Income Tax Act will apply. Example, 111A, 112, 112A. These are just examples and not the final list. Are we clear? So, 115BB, 115BBJ, all of those will continue to be applicable. Okay. Now, what does 115 BAC says? This is fine. Now, 115 BAC will say that these are the typically tax rates which are there, which are applicable to individual or an HUF. So it says, notwithstanding anything contained in this Act, but subject to the provisions of this chapter, the income tax in respect of total income of a person, which is individual, HUF, AOP, BOI, or artificial juridical person. Until last year, this provision of 115 BAC was only applicable to individual or HUF. This year onwards, it is being extended to even AOP, BOI, and artificial juridical person. Are we clear? Now, income tax in respect of the total income of a person. Income tax in respect of a total income. So, total income, again, you will compute as per the provisions of this particular chapter itself because it is overriding all other provisions. And what are the tax rates which are given? The tax rates are up to rupees 3 lakh, nil. Rupees 3 lakh to rupees 6 lakh, 5%. Rupees 6 lakh to rupees 9 lakh, 10%. Rupees 9 lakh to rupees 12 lakh, 15%. Then 12 lakh to 15 lakh, 20%. And above 15 lakh, 30%. So this is how your new slabs or the default slabs will look like from this year onwards. Vanshika, 115 BAC exemptions would be mandatory applicable in default regime. I didn't get your question exactly. So 3 lakh to 6 lakh 5, 6 lakh to 9 lakh 10, 9 to 12, 15, and then 20 and 30, 12 to 15 and above 15 lakh. So basically there is 5% increment in the tax rate except from 20 to 30 directly and then 3 lakh difference between the slab rates. However, this comes with the rider. This comes with the rider because these are the concessional tax rate. The government is giving you the concession in terms of the tax rate. The government is expecting you not to claim certain exemptions and deductions. But before that, we will see what are the general rates of tax. So to make a thorough comparison between the tax rate. So under the general regime, this is optional. General regime is optional. And what are the tax rates under general regime? Same. Up to rupees 2.5 lakh nil. Here you are getting up to rupees 3 lakh as nil. Rupees 2.5 lakh to rupees 5 lakh is 5%. Rupees 5 lakh to rupees 10 lakh is 20%. And greater than rupees 10 lakh is 8%. Now here if you look at it, greater than 15 lakh is 30%. 5 lakh to 10 lakh here is 20%. Right? Here, if you look at it, up till 5 lakh, you are in 5% bracket. Even up till 10 lakh, you are coming into, or 9 lakh, you are coming into 10%, whereas here you are going into 20%. Even when you move to 10 lakh rupees, you are still at 15%, whereas here you would have been at 20%. Are we finding that difference? So this is for other than senior citizen. For the senior citizens, for the resident individuals greater than 60 years, the slab rate is going to be up to rupees 3 lakh. It is nil. 3 lakh to 5 lakh. Sorry, 3 lakh to 5 lakh. 5%. 5 lakh to 10 lakh. 20%. And greater than rupees 10 lakh is 30%. And for resident individual greater than 80 years, greater than 80 years, up to rupees 5 lakh nil. 5 lakh to 10 lakh, it is 20%. And greater than rupees 10 lakh is 30%. But be mindful, this is only applicable for resident individual. If a senior citizen is a non-resident, you will have the normal slab which is applicable. Only if an individual who is a senior citizen is a resident, only then you can have that higher tax slabs which are available. Now there is one small circular which we will just discuss over here since we are talking about the senior citizen. So, as I said that a resident individual who is either more than 60 or more than 80 can have the higher basic exemption limit of 3 lakh and 5 lakh respectively. But what issue which arises is that he should be more than 60 years. Now, in case of a person whose date of birth falls on 1st April, so whether a person born on the 1st April can be said to have completed the particular age by 31st March. Because you know what will happen, just because of that 1 day window, he would lose out on that higher slab which is there. So my birthday is falling on 1st of April. So can I say on 31st of March, like till 31st of March, I was 59 and then at 1st of April, I become 60. So can one say that on 31st of March, I finished off my 60 years, like 1 day before? Because you know, when I'm born, that was 1st April, whatever year it was. And now at this particular date, so 1 day before, ideally, it will get completed. So can I avail for that previous year the higher basic exemption limit? So Supreme Court in one of the decision basically, which was not in tax context, but it had observed that when you're counting the age of person, it starts from the 12 o'clock in the midnight and he attains the specified age on the day preceding. Like even when you count a year, right? How a year you will count? You will count it like 1 day prior, your year will get completed. So therefore, the CBDT also clarified in that respect that a person who is born on 1st of April would be considered to have attained a particular age by 31st March, the day preceding his birthday. And based on that, he would be considered as senior citizen or very senior citizen. So therefore, if a person's birthday is on 1st of April, he is going to be 60 years on 1st of April, but he would be treated as having completed 60 years by 31st of March and he would be eligible for the 3 lakh limit and likewise for the 80 years. Are we clear? Now again, moving on to the 115 BAC. Difference between the old tax regime and the new tax regime. Shankara, that's what we are discussing. There are differences in the slab rates as well as there are differences in terms of the exemptions which are available or not, which are basically not going to be available under 115 BAC. That's what we are discussing. Kamlesh, if goes for general rates, any forms can be filled. I didn't understand your question. Which forms you are referring to? Okay. So as I said, under default, you have higher slabs also and you have lower tax rates also. Because if you look at default regime, which is there under which is the concessional rate, so up to 3 lakh, you have nil. Whereas under the general rates, up to 2.5 lakh, it is nil. Then 3 lakh to 6 lakh, it is 5%. Whereas under old regime or under the general rates, it is 2.5 to 5 lakh, it is 5%. So the 6 lakh, from 5 lakh to 6 lakh, that 1 lakh which is there will go under 20%. Because 5 lakh, 10 lakh, there is directly 20%. Whereas if you look at the concessional rate, from 6 lakh to 9 lakh, it is 10% still. 9 lakh to 10 lakh, you would have been taxed at 20% under the general rate. But here you are still going to be taxed at 15%. More than 10 lakh, it is directly 30% in the general. But under the concessional, till 15 lakh, you are allowed 20%. So the government is giving you the higher slabs and the lower tax rates. But as I said, it comes with a rider. 115 BAC comes with a rider. And what are the riders which are there under 115 BAC? So for 115 BAC, you cannot claim certain exemptions and deductions. And what are those? Now let's discuss in detail about that. So for the concessional tax rate to be taken, as I said, this is a default scheme. This is a default tax rate which is there. And what are the conditions? That you cannot claim while computing your total income these particular exemptions. So, exemptions total income without claiming following exemptions or deductions. What is the difference between exemptions and deductions, student? What is the difference between exemptions and deductions? I hope by CA final you would have been aware about it. Very basic question. Prerna, for senior citizens, very senior citizens under 115 BAC, for everybody the tax rate is going to be same. There are no separate tax rates under 115 BAC. Under 115 BAC, you have a single rate for everybody. You don't have different tax rates. Okay. How to opt out from 115 BAC to general rate? You will have that option in the income tax return. Shankara, if we are old tax regime, so the tax rate is high for a slab, but we can still claim certain exemptions, so that won't that be beneficial? Yes, it would be, Shankara. So you have to make comparison for each and every client. So this we used to do even when we were comparing while 115 BAC was optional. So whenever you are looking at a particular question, you have to make always the comparison. When I have these exemptions and I apply the general rates, whether that is better, or when I apply the concessional rate without exemption, whether that is better. So based on that comparison, wherever the final tax liability is lower, you will go ahead with that. Fine? Okay. So basically, what are the exemptions or deductions? What is the difference? Exemption is not included. Yes, Geeta. And deduction is first included in the income and then deduction is allowed. Yes, Geeta. Absolutely correct. So exemption is not included in the income. So it does not go to the total income, and deduction is allowed only once the particular income is included. It is then allowed as the deduction. Fine. So following exemptions or deductions are not allowed. What are they? Let's write it down. Let's write down over here. Give me a minute, 1 second. Yeah. 10.5. Leave travel concession. Leave travel concession under section 10.5. So if you were calculating or considering the leave travel concession under the general, here you would not be allowed. Housing rent allowance, HRA, under section 1013A. Housing rent allowance under section 1013A. Then exemption for the special allowances. Exemption for the special allowances under 1014. under section 1040. Then daily allowance or constituency allowance of MPs and MLAs. Daily allowance or constituency allowance for MLA or MP. Okay. Then exemption for the minor children. Under section 1032. What is the exemption for the minor children under 1032? What is it? Yes. Faster. You said you have completed the modules, right? You have studied this. Yes. What is 1032? For the minor children, you get the exemption when the particular income is there, right? Which income? Which income is there? Yes. So in case there is clubbing of income of minor in the hands of parent, then 1500 rupees in respect of each minor is allowed as the exemption to the parent, right? Yes, Ravish, correct. Clubbing of the income with the parent. Yes. So that is under 1032. So when, let's say, for example, the minor's income is clubbed, you will not get this particular exemption now under 1032. So 1500 exemption will not be available. Yes, Shankara, you need to compare for each individual and opt for the regime which is beneficial to them. Then next one is 10AA, tax holiday for units established in SEZ. For units in under section 10AA. Here I am writing rupees 1500 for clubbed income of minor. Right? So that you remember. Then entertainment allowance and professional tax. Entertainment allowance and professional tax under section 16. So that means what? What is allowed? No, Vanshika, 100 per 2 children per annum. No, that is the for the salary. 1032 is for the clubbing. Okay, so entertainment allowance and PT will not be allowed as the deduction under section 16. Which is the other deduction in salary that is allowed? Which is all of your favorite deduction for the client. Because under salary, you know, the client doesn't get many deductions. Client comes and asks how we can save tax, especially salaried ones. Because what? Because they don't have many deductions available under salary. Yes, Ravish. Which is the one? Standard deduction. So means in the before the amendment, standard deduction was also not allowed. Before the amendment, the standard deduction was also not allowed to the taxpayers under the 115 PAC. But now they said that salary ones are really upset about it. So we should allow at least that because they any which ways don't get it. Anything. So at least let's give them this 50,000 under 115 PAC as well. No, Geeta, not 80 CCD. Standard deduction, Vanshika. Yes, Anaga, correct. Standard deduction. So at least we should give them standard deduction, and when they have amended this particular section through the Finance Act 2023, so standard deduction is allowed. So I'll write it here. Standard deduction allowed. Standard deduction is allowed, thankfully. And for this 50,000, the taxpayers are forever grateful, right? Okay. So under salary, you cannot claim the HRA. You cannot claim the leave travel concession. You cannot claim the entertainment allowance and the profession tax deduction. Are we clear? So basically, this cannot be claimed. And any other specified allowances which are there, even those cannot be claimed basically. So the standard deduction, in fact, we can claim that. Are we clear? Now, it says under 1014. So 1014 which is there, section 1014 which is there, that is basically in respect of the allowances which are allowed under the salary, which are considered as exempt. It is not HRA. HRA is under 1013. So 1014 has several prescribed allowances, which are special allowances, which are specifically granted to meet the expenses for the performance of duties. And then the rules prescribe those allowances, which is in the nature of those food coupons, traveling allowance, conveyance allowance, transport allowance, all of those. Uniform allowances. So basically, those kind of allowances are under 1014. Now, whether those are allowed, because here they say 1014, the allowances will not be allowed, but it says other than prescribed. Other than prescribed. So what does it mean? So the rule which is there, so the income tax rules which prescribe these allowances, basically 1014 allowances. As I said, they give out the list of the allowances which are applicable, which are particularly exempt, and then they give out the limit also to the extent to which these are exempt. As I said, several allowances are there, right? Whether all of those cannot be claimed. So, for that, the government has issued a notification. And what is the notification? It says that the employee who has exercised the option under 115 BAC, oh sorry, not exercised, because now it is a default regime. So the employee who has not opted out, basically out of the 115 BAC regime. So as I said, 115 BAC is now the default regime which is applicable. So now you don't have to exercise the option for opting in, rather you have to exercise the option for coming out of it. So if a person is going for 115 BAC, then the allowances which are given under 1014, which are prescribed for the 1014, in that particular case, those will not be allowed. So it says that an employee who is an assessee, who is basically not exercise, or basically who is not going for 115 BAC and is opting out of 115 BAC, in that particular case, only they can claim the exemption under the 1014. However, the ones who are going for 115 BAC, the ones who are going for 115 BAC, for them, Certain allowances we will allow. Certain allowances we will allow under 1040. And these are the prescribed allowances which will only be allowed for them. And which are those? This is in respect of the allowances which are for the traveling purpose. The allowances which is only for the traveling purpose, any travel allowance, the conveyance allowance which are there, only that particular allowance will be allowed to the assessee. So, any allowances which is granted to meet the cost of travel on transfer of the taxpayer, let's say the taxpayer gets transferred, he will be allowed he will be given some traveling allowance because he would have to, go here and there, or he's sent on some tour, so he will be given some cost of travel. So that particular allowance will be allowed even under 115 BAC. Then, in case some conveyance allowance is given for the performance of duty, so again that will also get allowed to the assessee. So that will also be allowed to the assessee under 115 BAC. Are we getting that? So therefore, in respect of the 115 BAC, the following allowance will be allowed. So standard deduction is what I have written. Here you can write down traveling and conveyance allowance is allowed. Traveling and conveyance allowance is allowed. Traveling and conveyance allowance is allowed. Then, one more very important thing over here. Let's try and understand. Earlier, before the Finance Act 2023, there was the one more allowance which was allowed under 115 BAC. Which was allowed under 115 BAC. That was in respect of the food coupons. So, the companies give the food coupons to the employees to buy, food which is rupees 50 per meal, right? Which is particularly allowed. So, that was something which was also allowed under 115 BAC. Now, what is being provided for that? So, whether that is continued to be allowed even under the revised scheme, because now it has got amended. Now it has got amended because earlier it was allowed under the new scheme as well. Under the old scheme, still it is allowed. Under the old scheme, it is still allowed. There is no problem. So the value of the free food that you get and the non-alcoholic beverages basically, which is provided by the employer to the employee. So that is 100% which is allowed. And if the food coupons are given for the food to be purchased by the employee, the vouchers which are given, which can be used at eating joints, or nowadays, even you can use it on Blinkit, Dunzo, Big Basket, then 50 rupees per meal is basically allowed. So that is allowed under the old scheme. Under the new scheme till 2023 was also allowed. But now it shall not apply to the assessee who is going for 115 BAC. So you can write down that Food coupons, voucher will not be allowed. Food coupon, voucher, not allowed. Food coupon, voucher, not allowed. Are we clear? Yes or no? Any questions? Any doubt? Yes? Shankara, wait. We will talk about ATDA, all of that. Wait a second. But any doubt till now? Yes or no? Yes or no? Any doubt? Yes? Okay. So let's move forward. Then, which is the other deduction which is not allowed? So for salaries, we are clear. Yes? So as I said, for the salaries, we will not be allowed the standard deduction, will not be allowed PT, PF, PT, entertainment allowance. Then the HRA, leave travel concession, food coupons, these will not be allowed. What is allowed is only the traveling conveyance allowance and the standard deduction. Let's proceed further. Then you cannot claim. You cannot claim the interest on loan in respect of the self-occupied property under section 24. Under section 24B. So interest on housing loan on the self-occupied property is not allowed. But in respect of interest on loan on rental property is allowed. Interest on loan on rental property is allowed. So for self-occupied, you cannot claim, but if it's a rental property, it will be allowed. Fine. Standard deduction, 30%. 30% deduction, allowed, not allowed? Allowed. That is not disallowed over here. Okay. Next one. Now moving to the PGBP. What is not allowed? Additional depreciation under section 32(1)(2)(a). Meaning, normal depreciation is allowed. Normal depreciation is allowed. Additional depreciation is not allowed. Normal depreciation you can claim. Only that 20% additional depreciation we cannot claim. What else is not allowed in PGBP? The allowances or the deductions, special deductions which are given under 33AB, tea, coffee, rubber development. We will see all of this day after tomorrow. No, sorry, on Wednesday, which is next week. Because why Monday also we have class, ma'am, right? Yes, Monday we have class, but we are going to deal with the basics of the PGBP on Monday. Deduction for site restoration fund, section 33 ABA. Ma'am, do we have to remember this section? Yes. Yes, you need to. Scientific research expenses or deduction under section 35. Scientific research expenses under section 35. Yes. So scientific research contribution to the research association or Indian company for the scientific research or to any research association for statistical research or to a national laboratory, these are not allowed. So scientific research expenses for contribution to the university or research association for scientific research for the statistical research or for the statistical research for the contribution to the national laboratory IIT right or contribution to any Indian company contribution to any Indian company for scientific research. These will not be allowed. These will not be allowed. So under section 35, again, we will be discussing it in detail, but section 35, we have these scientific research expenses which are allowed as the deduction. But if any expenditure is laid out on own business, that is allowed. So if I lay out any expenditure, either pre-commencement or after the commencement of the business for the scientific research, that is something which is allowed. If any contribution is paid to a research association for scientific or statistical research or to any Indian company for scientific research or for the basically contribution to IIT or national laboratory, that is not allowed. But if I am doing it for my own business, any expenditure that will be allowed. So that's why I gave you the list. So what is allowed is scientific research expense, scientific research expense laid out for the scientific research related to business or related to business by one own self, including the expenditure incurred before the commencement of the business on the payment of salaries or purchase of any materials 3 years prior to the commencement of the business are also allowed, except the one which is there for the land, because no deduction is allowed for the land basically. So scientific research expense related to the business, including the expenditure prior to commencement of business. Capital expenditure is also allowed. Capital expenditure is also allowed, except for land. This is also allowed. Capital expenditure will also get allowed. Are we getting that? So these expenditure will be allowed. Other than that, if you're contributing to any company, that will not be allowed. Okay. Now, what else? What else is not allowed over here? So 35 AD, which is investment based deduction. Investment based deduction under section 35 AD. It is not allowed. And 35 triple C for agriculture project. Deduction for agri project under section 35 triple C. And finally, the doubt you were asking me, Shankara, regarding the 80C to 80U, that is also not allowed. So 80C to 80U, chapter 6A deductions are not allowed except two. Chapter 6A deductions are not allowed except what is allowed? The employer's contribution towards the NPS under 80CCD2. So, employer contribution to NPS under section 80CCD2. There's a new deduction which is the government contribution towards Agnipath scheme. Not a movie, but there's a scheme, Agnipath scheme, the central government contribution under section 80CCH. And the employee deduction under section 80JJAA. So if you hire new employees, you get deduction under 80JJAA. That is also allowed. So except these three deductions, nothing will be allowed. Fine. Depreciation, as I said, will be allowed. Additional depreciation will not be allowed. Carry forward and set off of losses. So any carry forward or unabsorbed depreciation is allowed, but it should not be attributable on account of these expenditure. So if, let's say, for example, I had the brought forward losses, which was because I claimed these deductions which are not allowed under the 115 BAC, then I will not be allowed the set off of the losses. But otherwise, the carry forward or the unabsorbed depreciation, if it is not on account of these expenditure, then it will be allowed. Further, the carry forward and set off of the loss under the head house property with any other income would not be allowed. So, then write down carry forward and set off of losses and depreciation on account of the deductions, not allowed under section 115 BAC. And secondly, house property loss, set off of house property loss against any income. But what is allowed is set off and carry forward of losses allowed if not pertaining to disallowed deductions. So even capital losses carry forward and set off allowed. But that is always against the capital income only. So capital loss can be set off against capital gain only. Right? You can, if you have the UAD and Brought forward losses you can set off, but you have to just check. It should not be on account of, let's say, 35 AD or additional depreciation or maybe, any scientific research expenditure. It should not be in relation to that. 80 AA Shankara I'll explain in the deductions class. Okay? Not now. It is just for the, if you hire new employees, you get that deduction. Clear? Yes or no? Is it clear? Yes or no? Also, one more deduction is allowed over here, which is 80 LA for the units in IFSC. 80 LA for units in IFSC. That is specific to the units in IFSC. So what is allowed? Now we'll just take a note of that. Traveling conveyance allowance is allowed. So traveling allowance is granted to meet the cost of travel on the tour or when the employee is basically transferred. Any kind of traveling allowance which is given with respect to the daily travel to the office by the employee if he has gone to some other office from the regular place of business. Any conveyance allowance which is granted to meet the expenditure in respect of the performance of his duties, that is basically allowed. So these are interest against the rental property will be allowed. Interest against the rental property will be allowed. Right? So that will be allowed to the assessee. Then what else? The normal depreciation. Then scientific research expenditure for own business, capital expenditure, employer contribution to NPS, Agnipat scheme, central government contribution and deduction under 80 AA and EPL. Then losses can also be allowed if it is not in relation to these deductions. Yes or no? Clear? Yes? Any doubt? Any questions? Yes or no? Yes? Yes. One more allowance is also allowed, which is, I forgot to write it over here, traveling and conveyance allowance. And then there was one more allowance which was there, which was what? Transport allowance, which was a transport allowance which was granted to the employee who is handicapped. Transport allowance of rupees 3,200 per month to handicapped employee. So that is also allowed. Okay. Ravish, what about the house property loss in the form of loan interest of let out property? Can it be set off against other head? No, there's a restriction over that. It cannot be set off against other heads. So brought forward cannot be there, but yes, during the year you can. So if you look at 115 BAC, what does it say? That these losses shall not be allowed. And there's a specific restriction on these losses. So it says that the loss and the depreciation shall not be basically allowed. And the loss which is in respect of these particular deductions will not be allowed. Yes. So without any set off of the carry forward loss or the unabsorbed depreciation from the earlier assessment year, if such loss or depreciation is attributable to these deductions which are not allowed, and any set off of loss under the head income from house property with any other head of income shall not be allowed. So even let's say, for example, during the year there is a loss under the house property, that loss shall not be set off. It should not be only the brought forward loss, but even the loss during the year, because it says set off of any loss. Whether brought forward or whether the current year, it doesn't say. So meaning the current year also, it cannot be set off. Are we clear? Yes or no? Vinay, this is for the AY 24-25. Okay, which is for May 24 attempt. This is not for November 23. Yes or no? Clear? Okay. So this is 115 BAC. Now, under 115 BAC, as I said, the individual will also not be allowed for any kind of exemptions or deductions which are given here. Other than that, let's say, for example, the normal deductions which are allowed to you for interest from the business or profession, for PF contribution under 36, that will be allowed. Because here what it says is that the total income shall be computed without allowing these deductions or exemption. What it says is that for the purpose of computing the total income, of a person, it shall be computed without any exemption or deduction under these sections. Meaning the total income which is computed normally, that will be computed because it refers to the word total income. But while computing this total income, we will not allow this because I am overriding the rest of the provisions of the Act. Okay, so only these mentioned will be allowed. Secondly, as I said, that the depreciation will be allowed, but that shall be restricted to 40%. That shall be restricted to 40%. Now, one more very important thing with respect to the depreciation. Let's say, for example, that there is depreciation in respect of the block of asset from an earlier assessment year, which is because of the additional depreciation claim. So there is, let's say, the unabsorbed depreciation which is there. Let's say there is a person, he has the unabsorbed depreciation on 1st of April from the last year. And that unabsorbed depreciation is because of the additional depreciation of preceding years. Now, if he goes under 115 BAC, if he doesn't opt out, the unabsorbed depreciation of the earlier year, which is there, would not be available for set off against the current year income. And what will happen is, you will have to also increase the WDV of the block during the particular year. Are you getting this point? So what did I say? That you will not get set off of losses and the unabsorbed depreciation if you have any unabsorbed depreciation or set off of loss which is pertaining to the disallowed items. So unabsorbed depreciation will be allowed to you if it is pertaining to a normal depreciation of earlier years. But if, let's say, for example, if the unabsorbed depreciation was on account of the additional depreciation claimed in the last year, so you will not get that set off of the unabsorbed depreciation. Additionally, what you will have to do is, you will have to increase the WDV as well to calculate the normal depreciation of the current year. Are we getting that? So just write down over here. Unabsorbed depreciation pertaining to additional depreciation is not allowed. But unabsorbed depreciation pertaining to normal depreciation is allowed. So what you will have to do, if it is pertaining to additional depreciation, then what you will have to do? Add to WDV of block of asset. Add to WDV of the block of asset. Yes. Shankara, so loss on house property from interest on loan of SOP is not allowed, but loss on house property from interest on loan of rented property is allowed. No, Shankara. Any loss which, so interest on rental property will be allowed, but if it results in a loss, then you will not be allowed that loss. So interest on house property, nobody is saying that it will not be allowed if it is a rental property. If it is SOP, it will not be allowed. If it is a rental property, it will be allowed. Only thing is that the loss, if it results in a loss, it will not be allowed. Okay? Because opting out, when will the assessee have to take at the time of TDS deduction or only at the time of filing return? So he has to exercise the option at the time of TDS also, like when the year starts, the employer would collect the declaration. At that time, you have to choose whether you want to opt out of 115 BAC. If you do not opt out, the employer will deduct the TDS as per 115 BAC. At the time of filing the return also, you can then later on change. Clear? Yes or no? Any doubt? Yes? Okay. Now, what is the time limit for exercising the option to opt out of the default regime? So, let's write down. Opting out of default tax regime. Opting out of default tax regime. Assessee with business or profession. This is other than business or profession. In case the assessee has income from business or profession, then he can exercise this option before the due date of filing return of income under section 139(1). And once he opts out, that option will apply to all the years. So once he has withdrawn from that scheme, he has to go as per the normal scheme only. So once a person has exercised the option of opting out of the 115 BAC, he can only withdraw that once and pay the tax under the normal regime. Right? So then that option will apply to the subsequent assessment years. Then that option shall apply to the subsequent assessment years. And then he cannot exercise the option ever except when the business will cease. So a person who has exercised the option of opting out of the default tax regime will be able to withdraw that option only once. So only once he can go back to the 115 BAC. Once you have opted out, can you go back again? Yes, only once. Only once you can go back to 115 BAC again. Otherwise, once you have now gone to 115 BAC, then can you again opt out? Answer is no. So you have the option only once till your business is there that you can opt out and again opt in. And once you have opted out and then again opted in, you cannot then come back. So opting out, you have the option available during the due date of filing return of income Can he opt in? Or let's not use word opt in. Can he go back again to 115 BAC? Yes, only once. Yes, only once. Only once he can go there. And then he cannot again withdraw. Are we getting that? So a person where he basically will have to opt in, opt out of the 115 BAC. He can opt out before the due date of filing return of income, and this will apply to all the subsequent years. Option apply to all the subsequent. The option will apply to all the subsequent years. Are we getting that? Any question? Okay. Any doubt? Any question? Yes. Retrospective effect, Ravish, meaning? Yes, Sanarga, there are amendments for May 24 exam. But I would suggest the November 23 students, this particular session is not applicable because you will get confused. If you are November 23 students, for your attempt, we have already taken the lectures in the past in July. So these lectures are only for May 24. Yes or no? Are we clear? Yes. Any doubt? Yes or no? So earlier, what you used to what you used to do is that you had to exercise the option to come under 115 BAC. And for a person having the business or profession income, they had to exercise the option to come inside this particular provision. And once exercised, that option could be withdrawn only once. So he could move out only once and then he will never be able to exercise except when his business just ceases to exist. Now what it says is, now it says that when a person has to opt out of this provision. Now the person has to opt out of this particular provision. This particular regime is default only. This particular regime is default only. So now what it says is that 115 BAC will not apply where the person exercises the option to opt out. And if he has a business income, he has to exercise the option on or before the due date under 139(1), which is the return filing due date. And such option shall apply to all the subsequent assessment years. And this option of getting out can be withdrawn only once. So means you can get back only once. And thereafter, the person will never be able to exercise to again go out of this scheme. So for a person having the business or profession income, he cannot opt in, opt out, opt in, opt out. He cannot do like that. He will be there. He will be governed by 115 BAC as default. If he wants to be governed by normal provision, opt out. Now, once you opt out of this, you cannot come back to 115 BAC because the option will be exercised for all the subsequent years. You can come back to 115 BAC only once after going out. And once you come to 115 BAC again, you cannot then go out of it. For person not having business income, for them, they can choose or withdraw each year. So, for other than business or profession, choice to opt out available each year to be exercised before the due date of section 139. The problem is only for the business or profession assessee. Okay, Vanshika, if we opt out of 115 BAC and chooses general regime next year, what scheme he would be taxable in the general regime only? Vinay, he can opt in only 1 to 115 BAC, yes. So if you opt out of BAC and the next year if you opt into BAC, then you cannot go out of BAC. Yes, you are correct, Vinay. Clear? Any doubt? Are we clear about 115 BAC? Yes or no? Yes. Last one point, the AMT will not be applicable. So AMT, alternate minimum tax, not applicable for 115 BAC. But for the normal provision, this will be applicable. So alternate minimum tax is not applicable. This is applicable only any which ways to the taxpayers who have income from business or profession. Yes. So only for the normal taxpayers this will be applicable. Fine. Now in the exam, there will be a specific mention as to that the person has opted for the normal scheme or the person has opted out of 115 BAC, this specific mention would be there. In case the mention is not there in the question, read the question carefully whether it is asking you to compute which provision is beneficial. If the question is asking you to compare which provision is beneficial, then you have to compute the tax rate as per the normal provision. You have to also make the computation as per the AMT. In case the AMT is applicable, we will see when the AMT is applicable. AMT is not always applicable. And you will have to also calculate under 115 BAC, and based on the lower tax liability, you have to give your answer. If the question is silent, it is not even asking you as to compute the tax which is beneficial under which provision. It is not even saying whether you have opted out of 115 BAC, then what to do? You have to go as per 115 BAC. Just write a note that you have assumed that the person has not opted out of 115 BAC. Remember this carefully. You will not write in exam that the person has opted in for 115 BAC. That is incorrect. That was till last year. Now 115 BAC is automatic. It is default. So you can only opt out of it. So you have to write, it is assumed that the person has not opted out of 115 BAC, and you will compute the tax liability as per 115 BAC if the question does not mention anything. Anarga 115 BAC is applicable to all, ROR, RNOR, NR, everybody. Yes, any doubt? Any question, any doubt? Yes or no? Are we clear before we take a break? Yes. Okay. So let's take a small break of 10 minutes and then we get back. Anarga, yes, you have to write that 115 BAC has not been opted out. For the assessee who has already opted for, no, you don't need to opt for 115 BAC. That's what I'm saying. 115 BAC is a default provision. Nobody has an option to opt in. Like earlier, when the general rates were there, did you opt in for the general rates? No. General rates were normally applicable to you. You chose to go for 115 BAC. Now you're choosing to go for general rates. So you're opting out of 115 BAC. 115 BAC is already there, right? Uh, because if you have brought forward loss in house property and the house property income in the current year, then can I set off with the income from house property? Yes, that's a very good question. So if you look at 115 BAC, again what it says is 115 BAC says that you cannot set off the loss from the house property. That's a very, very relevant and very good question. It says you cannot set off the loss from the house property under any other head of income. So means you can set off against the house property. Correct? So if you have a house property loss, you can set off against the house property income, but you cannot set off against any other head of income. Clear? Okay. Okay. So let's move further then. Now, rebate. We discussed about the tax rate. Now about the rebate. What is the rebate? Under section 87A. My rebate under 87A is how much? I have a rebate of 87A. So under the normal rate of tax, also there is rebate available. Under the 115 BAC, the rate is different. The rebate is basically different. So what is the rebate that I get under 115 BAC? So the rebate which is there under 115 BAC is if the income does not exceed 7 lakh. If the income does not exceed 7 lakh, the rebate is rupees 25,000 for income up to rupees 7 lakh. Rebate will be 25,000 or the whatever tax amount is there up to rupees 7 lakh income. For the normal provision, the rebate is rupees 12,500 for income up to rupees 5 lakh. For up to income rupees 5 lakh, the rebate is 12,500. So that is my rebate under 87A. But rebate under 87A is allowed in both the new as well as the old scheme. Fine. So this will give my tax liability, then the surcharge. Now there are differences in the surcharges as well. Now what is the surcharge rate for the new scheme and for the old scheme? What is the surcharge rate? So tax rate that we saw, that you have a default tax regime under 115 BAC where you are foregoing certain exemptions and deductions and you have the tax rate there. Under the general rates, you have the tax rate there, right? Then you have a rebate under 87A and you also have then the surcharge. Now what is the surcharge which is applicable? What is the surcharge which is applicable? Okay, one more point. The rebate is applicable only to a resident individual. Remember that. Rebate to resident individual. It is not applicable to a non-resident. Rebate is only to a resident individual. Okay? It cannot be applicable to a non-resident. Fine. Okay. Now, going back to the surcharge. Yes. What is the surcharge? Yes, tell me. So, the surcharge rates which are there in case of the individual who has gone for 115 BAC, meaning he has not opted out of 115 BAC. For them, the surcharge is as per these slabs which are there. So just write down the slabs for the 115 BAC. Yes. So where the total income is less than rupees, where the total income is more than rupees 50 lakhs, total income, greater than rupees 50 lakh but less than rupees 1 crore. Total income greater than rupees 50 lakh and less than rupees 1 crore, including the long-term capital gain, short-term capital gain, including basically you can write the long-term capital gain or short-term capital gain. This is under 112 or 112A and this is under 111A, or the dividend income is greater than rupees 50 lakh and less than rupees 1 crore, then your surcharge is going to be 10%. Surcharge is 10%. Okay. Second, where the total income, again including the long-term capital gain, dividend and the short-term capital gain, is greater than rupees 1 crore but less than rupees 2 crores. Is less than rupees, less than equal to, you can write, is 15%. Then if my total income is greater than rupees 2 crores, is greater than rupees 2 crores, but total income excluding the long-term capital gain, short-term capital gain and the dividend, not including but the total income excluding. Total income excluding the dividend, long-term capital gain and short-term capital gain, the surcharge is 25%. The surcharge is set 25%. On the dividend, LTCG, STCG, the surcharge highest will be 15%, even if it exceeds rupees 2 crores. So, on dividend, LTCG and STCG, the highest surcharge will be 15%. Okay? Are we clear? Now, under the normal provisions, where the total income, I'll copy this only. You have to write it again. Okay. Where the total income is greater than rupees 50 lakhs, but less than rupees 1 crore, then it is 10% same. Then where the total income is greater than the 1 crore but less than equal to 2 crore, then it is 15%. And where the total income excluding the dividend is greater than 2 crore but less than 5 crore, but less than equal to rupees 5 crore, then the surcharge is 25%. But as I said, on dividend, long-term capital gain and short-term capital gain, the highest surcharge is 15%. Then, if the total income is greater than rupees 5 crore, then the surcharge is 37%. Total income excluding the short-term capital gain, long-term capital gain and the dividend. Then the surcharge is 37%. So here basically if you observe in the new scheme, the surcharge is 25%. But here you also have a 37% surcharge. Here you also have a 37% surcharge. So that is the difference between the rates of surcharge. Whereas, yes, the rebate is also available to RNOR. Yes, there is no distinction between NOR and resident and ordinary resident. It just uses the word resident. So the rebate will also be available to a non-ordinary resident. Yes, you're correct. Yes. So there is the difference in the surcharge rate. Now one question to you. Please be very careful what I'm talking over here. Now how do you determine the rate of surcharge? This is very, very, very important. Understand this very carefully. Now, let's say for example, my income is, let's say, 50 lakh, more than 50 lakh. My total income is more than 50 lakh. Now, out of my total income, if let's say for example, I give you the example over here. If let's say my total income is 1 CR. Fine, my total income is 1 CR. Now, out of which dividend is, let's say, 15 lakhs. STCG is, let's say, rupees 15 lakh. LTCG is, let's say, rupees 45 lakhs. And other income is, let's say, 25 lakhs. What will be my surcharge? What will be my surcharge? Yes, faster. What will be my surcharge? Yes, students, what will be the surcharge here? Yes, 10%. Yes, Shravanand. Yes, Ravish. Viraj. Yes. My surcharge in this case will be 10%. All of you are correct. Okay, this was very, very simple. Because my total income is exceeding rupees 50 lakh. So my surcharge here will be at the rate of 10%. Fine. Next is, let's say my total income. Let's say my total income which is there is, let's take a scenario where my total income is, let's say dividend income I have of 40 lakhs. So the total income is 2.77 crores. Total income is 2.77 crores, out of which my dividend income is 40 lakhs. STCG is, let's say, 35 lakhs. LTCG is 42 lakhs under section 112A, and let's say under section 112 is 52 lakhs or 50 lakhs, and other income is say 1.10 crores. What will be my surcharge? Yes. Yes, Vanshika, it includes dividend and all. So the dividend has to be included while computing the surcharge of 10%. If you look at it, it says total income including the dividend and all is if more than 50 lakh, less than 1 CR, then the surcharge is 10%. So we apply here 10%. Yes, Vikas, correct. Ravish, yes. Who says the surcharge should be 25%? Anyone thinks surcharge has to be 25%? Viraj, yes, correct. I am thinking that the surcharge should be 25%. Who is thinking like me? Yes. And if you're not thinking like me, give me the reason. Tell me, ma'am, you're wrong. The surcharge should not be 25%, it should be 15%. And this is the reason. What is the reason? Vinay, what do you mean by oh, only you? Only I am thinking, okay. But tell me the reason, na? What is the reason of not having 25%? I have a doubt. I think it should be 25. Yes. Why not 25? My total income is more than 2 crores. Ravish, I know I'm wrong, but why I'm wrong? I'm asking you the reason. Yes, Minay, correct. It says 15% excluding the LTCG, STCG dividend income if my income is less than 2 crores. You're correct. So the 2 crore limit is applicable. This particular 25% is applicable, but it says the total income excluding LTCG, STCG should be more than 2 crores. So excluding LTCG, STCG and dividend, my total income which is there is 1.10 crores. So then I will not go to 25% slab, meaning this will be 15%. So including the dividend and all, the total income is more than 1 CR. Excluding the dividend and STCG, LTCG, my total income is less than 2 CR. So 25% is applicable only when excluding STCG, LTCG and dividend, it should be more than 2 crores. Shravanan, for income except dividend, LTCG, STCG, 25% will not be there. If let's say for example, my dividend income, if let's say for example, if my other income would have been, let's say instead of 1.10 crore, my other income would have been, let's say 2.20 crore. Then on this income, 25% would have been applicable. On the rest of the income, 15% would have been applicable. Are we clear? But here, my total income, other than the dividend, STCG, LTCG, is less than 2 crores. Therefore, the direct 15% will be applicable. Clear, Shavanan? Yes, Vanshika, correct. Ramakrishnan, dividend is fine with 15%. Yes, Shankara. Yes, Vikas, correct. Okay. Yes. So are we clear about the tax rate, surcharge and rebates? Yes, for the individual. Also, the marginal relief will also be applicable in both the 115 BAC scheme and the general rates. So what is marginal relief? If your income exceeds marginally, so the marginal relief will also be applicable in surcharge also. The marginal relief will also be applicable in surcharge also. Well, let's say for example, my income exceeds by 1 CR marginally, then I will be having the marginal relief in case of the tax rate as well as surcharge, and it will be applicable for both 115 BAC as well as the normal income. Clear? Okay. Any other doubt? Any question? Yes or no? Any doubt? Any question? Surcharge is clear. Tax rate is clear. Okay. Yes or no? Fine. Okay. Now, next is the company. Next is the company. Also, as I told you, there are many questions in the module. So you have to solve them to just, get a hang of the tax rates. I'm not solving over here because there are these questions in the module. These are simple questions with no adjustment. Of course, we would do few questions when we would go into the PGBP and assessment of various entities. There I'll put this particular set of tax liability as well. But right now, I'm not going into that. Okay. Then for the companies, what is the tax rate? For the companies, again, there are multiple tax rates which are there. So just write down for the company. For the company, the general tax rate is 30%. Second one is for the small companies. What is the tax rate? So if the turnover or gross receipt in, if the turnover or gross receipt in previous year 21-22, previous year, not 22-23, 21-22 is less than equal to 400 crores, then it is 25%. It's very illogical that they are going 2 years past to check the turnover. I don't know. I mean, it should have been last year, but don't know. Nevertheless. Next is C, the concessional tax for the concessional tax for the manufacturing company. For the manufacturing company, it is 15%. It is 15%. And in case of concessional tax rate for others, for other company, it is 22%. It is 22%. Okay. Now again, there are certain concessions given. So therefore, the concessions are subject to the riders. Ramakrishnan marginal relief, as I told you, you have done an IPCC marginal relief if your income marginally increases. So they give you that relief basically so that you are not subjected to a higher slab rate. Because first step is to check the rates including STCG and LTCG. If they increase about 2 crores, then we have to bifurcate them. No. Because you need to check wherever the word including is there, you have to check including LTCG and STCG. If it is excluding LTCG and STCG, then you have to do accordingly. So for surcharge, which is 25%, the words used are that the total income, if it increases by 2 crore and less than 5 crore. But this total income excluding the LTCG and dividend and STCG. So for the 2 crore and 5 crore slab, the total income is without considering the capital gains and the dividend. So if that total income exceeds 2 crore less than 5 crore, then 25% surcharge is there. For the 15% and 10%, the income is including the LTCG, STCG and dividend. So depending on the wordings, you have to take it. So for the first two slabs, it's including. For 2 crores and 5 crore slab, it is excluding. Because on dividend and capital gain, the highest surcharge is 15%. Okay. Prerna 115 BAC rebate is available to resident. Resident means a ROR as well as RNOR. Shankara, I don't have any idea for the hard copy of study mat. I am not sure. You have to check with the branches. Ramakrishna, this is covered in this particular module itself, the basic concepts. Because if they cross this limit in 22-23, still they can claim this? Yes, they can claim this. Because what we are seeing is the turnover of previous year 21-22 and not 22-23. In 22-23, if your turnover is more than 400 crore, that also is fine. You can still claim 25% if you were having turnover less than 400 crore in 21-22. That's why I said it's very illogical. Okay. Now coming to the concessional regime, which is 15% and 25% or 22%. Now again, this is which is there is with some riders. So this is a concessional tax regime. This is coming up with the riders, as I said. What are the riders? That you cannot claim certain exemptions and the deductions. So the 15% which is applicable, first we will talk about that, which is under section 115 BAB. 115 BAB. And this is under 115 BAA. So 115 BAB provides for 15% rate to the manufacturing and electricity generating domestic companies. So mind it, this is what we are talking about is the domestic company. Let me just make a bifurcation over here. So a company, this is my domestic company. And then we also have a foreign company. Okay. So 115 BAB, which is applicable, is for the manufacturing and the electricity generating domestic companies. Now, as I said, this 115 BAB is for the domestic manufacturing or electricity generating company, which are basically the new companies. So, manufacturing plus electricity generation. Manufacturing plus electricity generation. So, this is at the rate of 15%. 15%. Okay. Manufacturing plus electricity generation. The rate of tax is 15%. Now, what are the other conditions which are applicable over here? Here, the conditions which are there are that this company should be engaged in the manufacturing. This company should be engaged in the manufacturing or the electricity generation. There is also the condition on when it has started the business. So these are the conditional tax rates. Only when you fulfill those conditions, these particular provision will be applicable. Again, this is a non-obstant provision, meaning it overrides all other provisions of the Act, but is subject to the provisions of this chapter. Meaning, if you have a special tax rate, which is applicable under 112, 111A, all of that. So those will continue to be applicable. Okay. So if you have long-term capital gain, short-term capital gain, let's say for example in the exam you're getting a question where there's a long-term capital gain or short-term capital gain, then the 115 BAB tax rate will not be applicable. It will be 112, 112A or 111. Okay. So you can write it over here. Income taxable at special rates specify rates under the Act. Okay. So that shall continue to be applicable. So number one condition is it should be by the manufacturing company or electricity generation company. The company should be registered. The company should be registered and set up. So basically you can write set up and registered. Company set up and registered. Company set up and registered on or after 1st October 2019. On or after 1st October 2019, but before 31st March 2024. Before 31st March 2024. So the company should be a new company after 19 October and before 31st March 2024. Okay. The business should not be formed by splitting up or reconstruction of a business already in existence. Business not formed by splitting up or reconstruction of already existing business. The business should not be formed by reconstruction or the splitting up of existing business, meaning it should not happen that I'm just starting a new company to claim this particular beneficial rate. It should not be an old business taking the curtain of a new business. It should not be like that. Okay. Second, it should not have any machinery or plant which is previously used for any purpose. So, not formed with old plant and machinery. Not formed with the old plant and machinery. Again, there is an exception to that. And what is an exception to this? The exception is if it is formed with the imported second-hand plant and machinery, it is fine. So if it's imported second-hand, it is generally considered new only in India. So second-hand imported, if it is there, it's still fine. We will allow it. Okay. And secondly, if the second-hand plant and machinery's value is less than 20% of the total value of plant and machinery, then also we will say, okay, you have not, formed with the entire old plant and machinery. If your second-hand plant and machinery is there, but it's less than 20% of the total value, we will still allow it. It should not happen that you have, introduced entire old machinery into this particular new company and just to claim that particular 15% rate. So if second-hand plant and machinery or the value of the second-hand plant and machinery, value of second-hand plant and machinery is less than 20% of total value of plant and machinery. So these are the two exceptions which are given to you. Okay. So two exceptions which are given to you. One is that it can be a second hand imported and it could be less than the value of the second hand plant and machinery is less than the 20% of the value of the entire plant and machinery. Are we clear? Next is the company is not engaged in any business other than the business of manufacturing or production or distribution of the article which is manufactured or produced by. So it should be only engaged in the business of manufacturing and the production, and along with it, it can also be engaged in the distribution. Are we getting that? And that is only when you will be allowed this particular 15% tax rate. Where if there is any income, which is not derived from the or is not incidental to the manufacturing or production, then on that particular income, if there is no separate tax rate which is also provided under the Act, then on that income 22% tax rate will be applicable. Then on that income 22% tax rate will be applicable. So first of all, it is saying that you cannot have, if you want to claim 15% tax rate, you should not be engaged in any business other than the business of manufacture. Of course, you can have some incidental income. You can have some incidental other income, but that should not be a business income. So, should not be engaged in any other business other than manufacturing or production and distribution. Okay, other than manufacturing or production and distribution. Are we clear? Now, for that purpose, they have given an explanation clarifying that what do they understand by the business of manufacturing or production, and which shall not include these particular items. So, as I told you, the explanation can be introduced to the section to clarify something. So, the purpose of the explanation is to clarify something. The purpose of proviso. Proviso means what? The word proviso is not written anywhere in the Act. Proviso, how will you read a proviso? Wherever in the Act it is written as provided that, provided further that, which means it's a proviso. Proviso creates an exception. Like just for example, right now I said that the business should not be formed by splitting up or reconstruction. And then it says, provided that this condition will not apply in the following scenarios. Or the business should not use old plant and machinery. But provided that this particular. So proviso is basically an exception, explanation, clarifies something. So what they have said is that the business of the manufacturing shall not include business of the manufacturing shall not include business of manufacturing shall not include what it shall not include? Business of development business of development of computer software, development of computer software, mining, these are not considered as manufacturing. Conversion of marble blocks into slab, then bottling of gas into cylinder, printing of books or production of cinematograph films, cinematographic films. So these are not considered as the manufacturing operations by the government. So therefore, these are excluded. Are we clear? So these are excluded. Fine. Then what is the next condition which they have given up? That the total income shall be computed without any deductions under the following. So these were the conditions basically. And then we have a total income condition. Total income computed without deduction under total income computed without the deductions under the following. Now, what are the deductions which are disallowed? Let's look at it one by one. Okay. So, number one is the 10AA, which is exemption from the profits of the units in SEZ. Deduction under section 10AA, units in SEZ, which is applicable for the units in SEZ. Second is additional depreciation. Second is additional depreciation under 32(1)(2)(a). Additional depreciation under section 32(1)(2)(a), meaning normal depreciation is allowed. Normal depreciation is allowed. Next is 32(a)(d) investment allowance. Investment allowance under section 32(a)(d). Then tea, coffee, rubber development under section 33(ab). Site restoration fund deduction under 33(aba). Then scientific research expenses, what we studied even for individual. I'm just copy pasting from there to save time. You have to write it fully. You are not writing on computer, right? So this is scientific research expenses deduction. But what will be allowed is the capital expenditure and the revenue expenditure, right? So that will be allowed. Fine. Oh, what happened? One second. So that will be allowed. Okay. So scientific research expense deduction under 35, these will not be allowed. Then 35 AD, which is investment allowance deduction, which is there. So that I wrote here. Sorry, it should be 35 AD and not 32 AD. 32 AD is no more there. So 35 AD. Then agricultural project 35 CC. 35 triple C. Then chapter 6A. Chapter 6A deductions other than 80 double J double A and 80M. 80 double J double A was for employment related and 80M is for dividend. For the new employees and this is for the dividend. So these particular deductions will not be allowed. Yes, you have to learn this because Ravish, this is just the tip of the iceberg. The entire paper is very vast and that's what we are here for. We have to make it very simple so that you get a good score in direct taxes. It's not difficult. You know, this is something which you would love so much by the end of these papers that maybe, who knows, you become a direct tax expert later on. Right? You know, there is a specialization in direct taxes as well. Like, you know, it's not that you can be a direct tax expert. There are people who sub-specialize in direct tax. Transfer pricing experts, international tax experts, search-related experts. There are settlement commission experts which only handle settlement commission case. Nowadays, there's no settlement commission, but it's a bar now. There are people who handle only bar cases, which is the authority for advanced ruling erstwhile. There are people who just handle the search related cases. There are the experts which are just handling the litigation, which is ICAI, High Court and Supreme Court level. So it's like super specialization is possible under the Income Tax Act because it's so vast and one cannot just specialize only normally in tax. You have to super specialize later on. Anyways, so we were on the point that we have 115 BAC, these particular exemptions not to be claimed. Okay. So next point is what you have to not claim is the again set off of losses or unabsorbed depreciation if it relates to these particular disallowances. Other than that, of course, you can claim the set off of losses. It's not that you cannot claim set off of loss, but if it relates to any of these items, then you cannot claim. So, set off of losses and unabsorbed depreciation relating to specified disallowances. Meaning you can claim set off and carry forward of losses. Other than that, other than these disallowances is allowed. Fine, it is allowed. Fine. Yes. Okay. Now, one more important aspect over here. What you have to understand here is that in case now you have claimed the losses, so only it should be without these disallowances. Like for example, we said it in individual, if unabsorbed depreciation is relating to additional depreciation, we will not give effect of the unabsorbed depreciation. We will only consider unabsorbed depreciation if it is relating to the normal depreciation. Are we clear? So that is what the purpose is. And it is same for both individuals as well as the companies. So the conditions, if you look at it, it is same both for the individual as well as the company. Are we clear? Next particular point here you have to understand over here is that this particular provision is an optional provision. This particular provision is an optional provision, meaning you have to again exercise the option. You have to exercise the option. If you do not exercise this option, you will not be able to go into this particular provision. So, like for example, in the case of individuals, the 115 BAC scheme was the default scheme. The 115 BAC scheme was in fact the default scheme. Here you have to understand this is not the default scheme, this is still an optional scheme. So if you want to go ahead with this, you have to exercise that particular option. Under the individual, you have to exercise the option of going as per the rates which are given in the Finance Act. Isn't it? You have to exercise the option to go as per the Finance Act rates. But here, you have to exercise the option to go for 115 BAB. If you do not exercise the option, you can go with the 30% rate or 25% rate, whichever may be applicable to you. So this is different from the individuals in that manner. Are we getting that? So if for an individual, 115 BAC was the default tax regime, and he had to exercise that particular option to go with the normal rates of tax. Here, 115 BAC is the optional, 115 BAB is the optional regime. 115 BAB is the optional regime and you have to specifically opt in for that. Are we clear? Any doubt, any questions so far? Yes? Yes or no? Yes or no? Any questions? Yes, there are certain questions which I can see. Yes. If this company is a subsidiary and it sell its product to the entity, that it can save profit. Because I didn't get your question. When an example for 20% of plant and machinery is, let's say for example, I have maybe 15,000 of second-hand plant and machinery and my total value of plant and machinery is 1 lakh. So my value of second-hand plant and machinery is less than 20% of the total plant and machinery and therefore I satisfy this condition. Vanshika, if the company is incorporated after 2022, it would fall under 30% tax rate and not under 25% tax rate. So, good question, Vanshika. If the company is incorporated, there is no condition of incorporation. So, means that you did not have any turnover for that particular year and you can still go for 25% because it was a zero turnover case. You need not fall under 30%. Yes. Any other doubt? Any other questions? Yes. Okay. So, like for example, in individual, that option had to be exercised, right? And that option that could not be withdrawn, right? There is one very important point that you have to understand here. Here also it's the same thing that you have to exercise the option, and then the option once exercised, you cannot again keep on going and coming back. You cannot keep on coming and going back in that particular provision. Are we getting that? So, you have to understand one thing very, very carefully. That in this case, you have to exercise the option before the due date of 139(1). When you are furnishing the first return of income. So later on, you cannot exercise this option. Let's say, for example, I am sitting in 22-23 and I have been incorporated in 1920. Can I exercise the option now under 115 BAB? The answer is no. I have to exercise the option while filing my first return of income. I have to exercise this option while filing my first return of income. I cannot exercise this option later on. And once this option is exercised, like individuals who had business or profession income, here also, once this option is exercised, it shall apply to the subsequent assessment year as well. And it cannot be subsequently withdrawn. It cannot be subsequently withdrawn. So just write down option to be exercised before first return filed before due date of under section 139(1). So it has to be the first return. In the first year itself, you have to exercise this option. Once exercised, it cannot be withdrawn. At least in individuals, you had the option to go back for once. Here, you do not have the option to go back again. Here, once you have exercised this 115 BAB option, you have to stick with it. You cannot go back. Are we clear? So domestic companies have to exercise these options, and they have to exercise the option in the very first year in which the company is set up. So first return means previous year in which company is set up. Remember this. So in the question, look at when the company is incorporated. Every information given in question may be relevant. So look at the date in which the company is incorporated and which year you are computing the total. If this is the first year, directly it should click in your mind 115 BAB, 115 BAB. Write it down so that you do not forget an end. See what happens when we start solving the question. Sometimes we are so engrossed in certain adjustment that we just forgot, or you just forget, certain points that we have to apply some other provisions as well. Like for example, you may be, in that exam mode in such a condition that you may just not look at the information given at the start of the question. ABC Limited incorporated on 1/10/2019 and is engaged in the manufacturing of shoes or footwear. You are required to compute the total income for the previous year 22-23. Now you will start applying 115 BAB also. But it's not applicable. You will waste your time, and the point will be you will not be able to solve other questions. Plus you will get wrong also. Because examiner wanted to test that you have to write in the exam the note that 115 BAB will not be applicable over here because this is not the first year of the setup. In the future years, it cannot apply 115 BAB. Then it can apply 115 BAA. It can apply, of course, 115 BAA, but 115 BAB has to be exercised in the first year of operation. But once the company exercises the operation, it cannot, provision, it cannot opt out for the regular provision. It would be continued to be governed by 115BA. Second most important thing, MAT is not applicable over here. Minimum alternate tax not applicable. This is for both the provisions. Minimum alternate tax is not applicable. Are we clear? Minimum alternate tax is not going to be applicable. Now, one more important thing over here. What if there is, as I said, long-term capital gain, short-term capital gain under 112, 112A, 111A, then that income would be subject to tax at the rates mentioned in 11112A or any other special rate of tax which is given. But what would be my surcharge? My surcharge would be, what would be my surcharge in this case? Income is taxable at the special rates. Example, 111A, 112A, 112. But what will be my surcharge over here? The surcharge will be 10%. The surcharge will be 10%. So even if my income is under 111A, 112 or 112A, my surcharge will be 10% because here also my surcharge is 10%. Here also my surcharge is 10%. So the surcharge is coming through the Finance Act. Surcharge is not provided under Income Tax Act. But here, if you look at it, the surcharge is always coming through the Finance Act. Are we getting that? So in the Finance Act, the surcharge for the income referred to in 115BAB is 10%. Is 10%. Are we getting that? So in respect of the income, which is chargeable even under 111A, 112A or 112, that shall be increased by the surcharge, which will be 10%. In case of a domestic company whose income is chargeable under 115BAB. For if I am going as per normal provision, 30% tax rate or 25% tax rate, then in that case, my surcharge will be 7% and 12%. But where my income is under 115BAB, where the domestic company's income is under 115BAB, the surcharge shall be at the rate of flat 10%. Because the Finance Act, you know what it says? Finance Act is saying that in case of a company, it says that where the income is under 111A, 112 or 112A, the surcharge will be 7% and 12%, which is provided in part 1 of the first schedule, except for the domestic company, which is going for 115BAA or 115BAB. For them, the surcharge will be 10%, irrespective whether their income is taxable under 115BAB or under 112, 112A or 111. So though I will go with the tax rate under 111A, 112 or 112A, my surcharge will remain as 10%. That is coming through Finance Act and not through 115BAB. Are we clear? Yes or no? Okay. Next very important point. Next very, very important point here is in respect of any other income, in respect of any other income for which no specific tax rate is provided in chapter 12. If there is any income which is not incidental to manufacturing or the production or generation of electricity. For example, I have house property income. I may have interest income, which is income from other sources. Then for that, there will be a flat rate of 22%. There will be flat rate of 22%. There will be flat rate of 22%. And further, there will not be any deduction of any expenditure or allowances. So, if I have any other income, other than any other income, not incidental to manufacturing or production or generation of electricity, then this shall be at 22% tax rate plus surcharge will be at the rate of 10% plus cess at the rate of 4%, which effectively brings it to 25.168%. And without any deduction of expense or allowance. Without any deduction of expense or allowance. So meaning I will not get any deduction of expenditure. It will be taxed at a flat rate of 25. Example, income from house property or income from other source. Means you will not get even the standard deduction on the house property rental income, flat rate of 25.168%. Are we getting that? Interest income, flat rate of 25.168%. Clear? Yes. If there is STCG, which is not under 111A. Under 111A, you have STCG on equity shares which are listed. If there is STCG, which is also not on the depreciable asset, on any other asset. So STCG on non-depreciable asset and other than 111A. On non-depreciable asset and other than 111A. Again on that, the tax rate will be 25.168%, which is 22 plus 10 plus 4%. Clear? So this is what 115 BAP is there. Now, one last aspect under 115 BAB. One last aspect under 115 BAB is that if there is if the AO is of the opinion, then the business between the company which is claiming 115 BAB tax rate and any other taxpayer with which this company has a close connection. If there is a company which is claiming 115 BAB and there is any other person which is having a close connection with this company, and the business of this company is arranged in such a way that the profits from the other company are being transferred to this company. So because it's a concessional rate of tax and at the rate of 15%, so everybody would want to, lower down the tax rate to 15% instead of 30% or 25%. And so what they will try to do is they will try to shift the profits from one business to another business. So if there is artificial shifting of profits, and if the AO identifies this, then he can recalculate the profits by reasonable determination as to what shall be profits which shall be reasonably determined by this particular company. And if this transaction which is there, this will be considered as a specified domestic transaction under section 92BA. Under section 92BA, and therefore what will happen? The transfer pricing provisions will be applicable. The transfer pricing provisions shall be applicable and arm's length price shall be applicable over here. And if it is found by the AO that the excess profits are here being transferred, then the excess amount will be taxed at 50%. Then the excess amount will be taxed at 30%. So, write down the transaction between company claiming 115 BAB rate and closely connected person will be a specified domestic transaction. Therefore, arm's length price will be applicable. Therefore, excess profits taxed at 30% plus the surcharge will be 10% plus 4%, which is effectively coming to 34.32%. 34.32%. Okay. Further, in case there is an amalgamation, then the option which is exercised under 115 BAB will also apply to the amalgamated company, provided the amalgamated company fulfills these conditions. So, you can write down here option exercised by amalgamating company will apply to amalgamated company. Yes, students, any doubt? Ramakrishnan, the authorities are not permitting any kind of tax planning. Yes, Vinay, there is so much to remember and therefore it is essential to revise. Because if it is manufacturing and it is in the repair business, then both are incidental to each other, one can say, but technically not incidental also, because repairing is a separate set of business. If it is, kind of repairing under warranties, then you may say that it's one business only, but it is, generally some repair services which are done, then in that case, they will be ineligible. It depends on how interlinked both businesses are. Ravi, if you can quote, it is nice because you are a CA final student and not IPCC student, so you have to quote section number. Ramakrishna, if the company still wants to change, what they can do, they can just go out of the scheme, but they cannot then come in. And once they opt out, then the 30% tax rate will be applicable to them. Old machinery in excess of 20% bought from different companies, Shravanand will not be allowed. Donation received for scientific and spent on itself, donations will not be allowed. It will be taxed only. It will not be taxed at 15%. Of course, yeah. If you are into that scientific research, if you are receiving that kind of donation, of course, you need first of all approvals. It's not very easy. You need to get that registration to obtain that approvals under 35 section. And you can get deduction only when you make the payments for the donations. Because yes, for going global, you need to specialize in transfer pricing and international tax. Vanshika, thank you so much. Ravish, yes, it's only 30% tax rate. Penalties will be under transfer pricing. We will see that. Okay. So, just quickly giving a recap of 115 BAB. Tax rate is 15%, surcharge is 10%, and cess is 4%, which makes the 115 BAB tax rate close to 17%. So the precise rate which is there is 17.16%. You can write down. Cess is 4%. So the precise rate is 17.16%. Okay. So the company should be registered and set up on or after 1/10/2019, but before 31st March 2024. Business should not be formed by splitting up or reconstruction. It should not be with the old plant and machinery. So second-hand plant and machinery is allowed only if it is imported or the value of the second-hand plant and machinery is less than 20% of the total value of plant and machinery. It should be only in the business of manufacturing, production, and distribution. What is not manufacturing is the mining, is the development of computer software, conversion of marble blocks into slabs, bottling of gas into cylinder, and printing of books or cinematographic film production. Total income is computed without deduction under 10AA, 33AB, 33ABA, 35AD, 35, and additional depreciation. Normal depreciation is allowed. Scientific research expenditure for own business is allowed. Contributions to other is not allowed. Chapter 6A deduction other than 80 JJAA and 80M. Set off of losses is allowed, but it should not be in relation to these deductions which are claimed. You have to exercise the option in the first year of setup before the due date of filing return of income. Once exercised, cannot be withdrawn. MAT will not be applicable. Other income will continue to be taxed at the specific rates which are there, but the surcharge will still be 10%. Any income which is not covered under any specific provision for which there is no specified tax rate, the income will be taxed at 20%, but without any deduction of expenditure. STCG on non-depreciable assets other than 111A will be at 22%. And if there is any profit shifting is found, then it will be at the 30% and will be covered by transfer pricing provisions. Fine. The last one, 115 BAB, it will not take that much time because it is similar to 115 BAA. So 115 BAA is similar to 115 BAB. So the tax rate is 22%. The surcharge here is 10% again. and cess is 4%. So effectively the tax rate comes to 25.168%. There is no condition which is applicable for the incorporation over here. So there is no condition specifically which is applicable for incorporation over here. So there is no time limit over here. So in case you are not going by 115 BAB in the first year, you can still go for 115 BAA. So existing as well as the new companies can avail the benefit. It should not be, it can be any business basically. So you can write down new as well as existing company can go. Even companies which did not opt for 115 BAB in first year can go for 115 BAA. Okay, then no condition for manufacturing, can be any business. Okay, it can be any business. There is no similar condition for splitting up, reconstruction. So no condition for old business because even the existing business can go. Right? So all these conditions are not present under 115 BAA. The only condition under 115 BAA is this. So this is common to both, that the total income is computed without deduction under 10AA, which is for units in SCZ, additional depreciation, 33AB, ABA, scientific research, or ATC to ATU under Chapter 6A, except ATJJ and ATM, and even for the set-off of losses. So both these points are absolutely similar in 115 BAA as well. Are we clear? In case of the company opting in for 115 BAA, the set-off of loss again will be allowed only to the extent it is not relating to any these kind of deductions which are disallowed. Also, ATLA is also allowed. You can write over here. ATLA is also allowed, which is for IFSC unit. Okay. And again, here also the MAT will not be applicable. If you have a brought forward MAT credit, you have to set it off first and then you can of course go for 115 BAA. Also here you do not have any transfer pricing provision being applicable. So here this condition also will not be applicable, which is transaction between companies under 115 BAB and closely connected company will be subject to transfer pricing. In 115 BAA, there is no similar condition. There is no similar condition which is there. Are we clear? So the only condition under 115 BAA is for the total income computation. So these are not the common conditions which I have segregated. Other than that, this is common. And again, this is only applicable to 115 BAB. Sorry. Now, with respect to the other income, which is to be taxed, as I said, this is also a notwithstanding provision. So, if there is any other income under 112, 112A STCG, that will continue to be taxed at that rate, but the surcharge will remain as 10%, which is what we have written over here, and the cess will be 4%. So income taxable at special rates will continue to be taxed at this rate only. Okay. Only if you are going for 115 BAB and BAA, the surcharge will be 10%. If companies go for 115 BAA and 115 BAB, else surcharge will be 7% and 12% respectively. Okay, else the surcharge will be 7% and 12% respectively. Okay, and again here there is no condition basically for other income which is to be taxed at 22% like it was there in 115 BAB, that if there is other income we will tax at 22%. Even short-term capital gain on non-depreciable asset we will tax at 22%, and we will not even give the deduction of expenditure or allowance in case of any other income. There is no such condition under 115 BAB. Now, as far as the exercise of the option is concerned, again here the option has to be exercised before the due date of filing the return of income. So the exercise of the option remains the same. The option has to be exercised before the due date of filing the return of income. Once you exercise the option, it would apply to subsequent year and it cannot be withdrawn. It cannot be withdrawn. So basically you can write down here. So again, this is something which is applicable to here. I'll just remove this match point here to avoid confusion. Or let me just remove it altogether. One second. Because this will unnecessarily create the confusion. Okay. So I will write these are the only conditions which are applicable to here. MAT not applicable for both of them. Okay. With regard to the exercise of the option, so the exercise of the option before due date of filing return of income under section 139(1). Once exercised, cannot be withdrawn. Once exercised, the option cannot be withdrawn. But it can be exercised at any point of time. In any year. Okay? It has to be exercised in any year. Now, in case you fail to satisfy the conditions of 115 BAA or 115 BAB. So in case you fail to satisfy the conditions which are mentioned, let's say for example under 115 BAA and 115 BAB, then the option would be invalid in respect of the assessment year relevant to the previous year and subsequent assessment years. The option will become invalid. Consequently, the other provisions of the Act would apply as if the option was never exercised. In case your option becomes invalid for 115 BAB, you can still go for 115 BAA. But if your option for 115 BAA also becomes invalid, then 30% tax rate. So, non-fulfillment of conditions option would become invalid and normal provisions would apply for 115 BAB. You can go for 115 BAA. For 115 BAA, normal tax rate. Okay. Yes or no? Yes. Is it fine? Okay. Yes, Vinay, very good. Uh, yes, Ravish, as I said, it's 30% and no other penalty. Ramakrishnan, in the module, all these provisions are given very much detail. STCG tax rate under 115 BAB for 111A, it will be 15%. For other than that, it is going to be 22% plus surcharge and cess. So any other income, it is 22%. Okay. Now, last one thing before I close this session, I'll just give you the surcharge rate for the domestic companies which are normally there. So here, my surcharge will be, if my income exceeds 1 crore but is less than 10 crore. If my income is more than 1 crore, less than 10 crore, then the surcharge is 7%. If it is greater than 10 crores, it is 12%. Okay. You can write less than equal to 10 crore. Okay. Fine. Then last one, foreign company. We have not finished the chart. Where are you closing your books? Don't close your books. I finish it off this. Foreign company, the tax rate is 40%. Foreign company tax rate is 40%. Surcharge will be income greater than rupees 1 crore, less than equal to 10 crore, 2%. Income greater than rupees 10 crore, 5%. Now you can close your books. Okay, fine. So quickly revising one last time so that it's consolidated. Tax rate 30%, small companies 25%, turnover of 21, 22 needs to be seen. 115 BAB, 115 BAA. 115 BAB is for manufacturing company and electricity generation company. 115 BAA is 20% concessional rate. 115 BAB, the conditions are company set up after 11019, 31st March 24, not formed by splitting up reconstruction, not with the old plant and machinery. Old plant and machinery allowed only to the extent of 20% of total value of machinery, or it is imported. Then these conditions are not there under 115 BAA. Under 115 BAA and 115 BAB, the common condition is, I write it here common because the chart looks little messier to me. This is, one second. Let me put it like this so that it's not messier for you at least. This is manufacturing condition, split up condition or business condition, we'll name it so that it's easier to remember for you. Plant and machinery condition. This is again manufacturing condition. Okay, this was not manufacturing condition. This is a setup condition. Okay, these conditions are not there in 115 BA. Deduction and exemptions, or deduction just, there are no exemptions over here. Restrictions. Common to both 115 BAB and 115 BAA. Okay. Then exercise of option. This is in the first year and that can be exercised at any point of time. And once exercised, it cannot be withdrawn. Then taxability of any other income. Any income which is taxed at the special rate, it will be continue to be taxed at the special rate. But here, any other income has to be taxed at 22% plus surcharge and cess of 10%. STCG on non-depreciable asset is to be taxed at 22 plus surcharge and cess, which is 10% and 4%. Any other income which is not incidental to manufacturing, you will not get any deduction of expense. Here, any other income is to be taxed at 22% plus 10% plus 4%. No similar condition of restricting, no similar condition of restricting expenses. Okay. Then transfer pricing applicability. Here in 115 BA it is applicable. Here it is not applicable. Okay. In 115 BAA. It is only in 115 BAB. Okay. MAT is not applicable in both the scenarios. And finally, non-fulfillment of conditions. If 115 BAB is there, you can go for 115 BA. But for 115 BA, you can only go for normal provisions. Oh, fine. Thank you, Ramakrishnan. So thank you so much. Please revise before you sleep tonight. And next, it's going to be very, very interesting because we are going to move to PGBP. We are still left with tax rates, little bit for the cooperative societies and for the firm. That we will cover it in the next class. Thank you, Ravish. Thank you, Vanshika. Okay, so good night, everybody. Thanks a lot. See you on Monday. We can close the session. Good night.